Hello, everyone, and welcome to our Market Outlook quarterly webinar. So thank you, everybody, for joining. I'm Philip Nelson, head of the Asset Allocation Group here at NAPC. Joined by me are Jen Appel, who's our resident inflation expert, and then also Josh Beers, who heads our private equity group here at NAPC. Before we get started, just going to hit on a couple logistical items. We're going to provide kind of an overview of kind of the last quarter in terms of what we've seen in market activity, and also some thoughts about how we're thinking about the current kind of bear market environment and kind of what that means for kind of economic trends. And then also Josh is going to provide some thoughts on kind of what we're seeing in the private market landscape as well. In terms of questions, if you do have questions, please enter them into the chat box on the top right, and we'll hit on questions at the end of this presentation. And then also this deck and the recording will be available on NAPC's website later this week. So with that, why don't we get into it, and we'll start with Jen, who's going to walk through the market environment and what we're seeing in terms of inflation.
Thanks, Phil. So to start, it certainly was another difficult quarter for capital markets, kind of across the board. You can see essentially every major asset class moved lower. And while performance was jarring in an absolute sense, we don't really view this as an outsized or irrational response by the markets, given that there were a number of significant changes to the market backdrop during the quarter. The market had to digest higher real and nominal interest rates, accelerated expectations for rate hikes by the Fed amid continued inflation pressures, which we'll get into shortly, and also broadly increasing recessionary concerns, all of which weighed on the market. Now, for U.S. markets in particular, the S&P 500 index had already had a tough start to the year. But with the drawdown in the second quarter, as we're showing on the following slide, year-to-date losses totaled about 20%. And that puts the first half of 2022 among the top in terms of worst starts to the year for the index. And that drawdown echoes a lot of negative investor sentiment out there for equities, which is clear from a lot of different data points, but especially if you look to things like bullishness surveys that are out there, those are for the most part hovering near all-time lows. And this is really just rooted in the fact that rising rates can have a significant impact on equity valuation. But there's also just a lot of uncertainty around the economic outlook that's weighing on short-term expectations. And now to put this in context a little bit more, on the following slide, we have some stats around market corrections. And market corrections happen frequently. Smaller corrections can even happen throughout the course of a secular bull market. So with the decline that we've seen through the first half of the year, falling below that 20% mark, we've technically reached bear market status in the US. But frankly, that threshold is a little bit arbitrary, since declines of any of these magnitudes can have a significant impact on portfolios. But with this bear market specifically, we have historically observed that while these types of drawdowns are less frequent, their duration tends to be extended. Oftentimes we'll see some capitulation in equities as sentiment and economic data starts to deteriorate. That leads to more of an initial decline, but frequently there's almost kind of another shoe to drop. And as we think about the current environment, there is still some optimism around consumption and corporate earnings that's supporting markets. So if we start to see either of those trending downward, that could cause another leg to this bear market. And with that in mind, it is possible that we could see these types of depressed conditions lasting for longer than expected. Now, if we look to historical US bear markets, they kind of come in all shapes and sizes. There are some that are on the shorter term side, like with what we saw in 2020 at the start of the pandemic, though that was more of an exogenous event. But we want to think about what's making conditions difficult today and compare if that's similar to the conditions that were present during some of these more protracted historical bear markets. And specifically, I want to hone in on the declines from 1973 and 74, but also the dot-com crash from 2000 to 2002, since there are some similar dynamics at play. For the 70s, at kind of a high level, supply shocks led to inflation that caused the Fed to tighten, and a high concentration of growth names started selling off. But then economic growth slowed and a recession took hold, which flipped the Fed to more of an easing bias. So the Fed wasn't necessarily reacting how they should have been in terms of managing inflation. Then the dot-com era has had some similarities as well, with the interest rate environment leading up to that period that caused a significant expansion of growth companies and subsequently a large decline in prices and a loss of investor confidence. So through the first half of this year, we've seen a fairly similar growth versus value dynamic at play, with value outperforming given the greater interest rate sensitivity of growth equity, and also growth had a more elevated starting valuation level as well. So as we think about this current bear market, we're not currently on pace to match some of the largest drawdowns historically, but we are cognizant that we could see the bear market continue and even worsen as the Fed continues to hike rates, or if we start to see some type of larger correction in earnings or economic data, for example. Now, thinking about the causes of this bear market, we did see the largest quarterly change in real yields in TIPS history. This move explains some of that performance we saw at the beginning, where everything was so negative across the board because discount rates moved materially higher. And in particular, the backdrop for so long had been one with negative real yields, but now their climbing has really shifted the risk asset backdrop. That risk asset sentiment and higher real rates in the US is also having an impact on the dollar. So should we see real rates continuing to trend higher, that's likely going to reinforce some of the strength in the dollar, and in particular could challenge non-US markets. But the other interesting thing here is that this move was on par with the magnitude and change in real rates that we saw during the taper tantrum of 2013. And at that time, real yields were also negative, and Fed Chairman Ben Bernanke signaled that tapering was coming. That caused a very significant move in real yields, and almost kind of reactionary volatility cascaded across markets. So bringing that to today, we're at a very similar starting point with an elevated balance sheet, but the inflation reality of today versus 2013 reinforces the tightening of policy that needs to occur. Now, looking a little bit more closely at inflation, we did see US CPI metrics once again accelerating during June, with the headline number coming in at 9.1%, which marked the fastest pace of inflation since 1981. And for those that have tuned in to some of our more recent quarterly calls, we've been highlighting that the near-term inflation environment is challenging and uncertain because a lot of the factors that are causing pressure today aren't going to go away overnight. You know, we've continued to see the high-level impact of supply-demand imbalances on the economy and how that's flowed through to consumer and producer prices. But there's also been a lot of knock-on effects from Russia and Ukraine that we're seeing come through in elevated food and energy prices as well. And while some of these components can be volatile, we've focused on stickier inflation metrics as well. And shelter is a big piece of that. Over a year ago, we highlighted that upward pressure in shelter prices would have kind of a steady impact on headline inflation, which we didn't believe was priced in by the market. And we've seen that come to fruition. In particular, with this most recent inflation print, rent increased at its fastest monthly rate since 1986. So while this is increasing, albeit at more of a slow and steady rate, shelter is about a third of the index, and it can continue to support elevated inflation going forward. And, you know, I think it's interesting, kind of one difference we're observing now relative to 6 months or a year ago is that this is not just one category driving inflation. The days of used car sales or airfare moving the headline number significantly are behind us. Inflation pressures have broadened across the board, where now most components are experiencing a greater than 5% annual increase. And this type of broadening out can sustain inflation pressures longer than anticipated, particularly as some of these price pressures move into the less quote unquote transitory components. So as we think about inflation going forward, we do believe that inflation is going to remain elevated for at least the next year. On the following slide, we have a fairly simple analysis, but if we take some of the numbers from the most recent inflation print and project that there will be no monthly change going forward, it would take 7 months for headline inflation to fall below 5%. That's pretty jarring. I don't think there are expectations from many that we're going to have a 0% or negative monthly change in inflation in the near term. And the particularly concerning part of this and the current environment is that there continue to be upside risks to inflation, one of which is wages. If we continue to see momentum in wages, that can further reinforce these price pressures and lead to numbers that are much scarier than these if rising labor costs start to get passed on to consumers through price increases. So all that being said, we are anticipating elevated inflation is going to stay in the near term. And if that's the reality of the current environment, it would appear that the Fed is behind the curve and that they're moving a bit too slowly. Historically, there's been a tight relationship between the Fed funds rate and inflation, and we've seen that hiking cycles don't typically end until after the Fed funds rate exceeds CPI. So essentially, these should converge, and it'll either take inflation coming down, which we just said is probably going to be pretty difficult in the near term, or the Fed funds rate to rise. So we think that the Fed policy rate still has some room to rise, but acknowledge that the concerns over economic growth are making that decision a little bit more difficult for policymakers. And this is all kind of what the market's trying to digest. We've seen market pricing adjust and pull forward rate hike expectations such that the peak is now 350 to 375 Fed funds during early 2023. And then the market's pricing in that the Fed will start cutting rates after that. So as we think about this all, it really comes down to what the path for inflation and Fed funds going forward is going to look like, since that will determine our economic trajectory and ultimately, from an investor's perspective, what portfolio construction and risk posturing makes sense. So with that, I'm going to turn it over to Phil to walk through how we're thinking about these dynamics going forward.
Great, thank you, Jen. As Jen mentioned, the market's definitely struggling to properly discount the future, let's call it economic paths for the market environment, and this is definitely reconciles with one of the themes that we've been talking about over the last 6 months, which is this idea of economic crossroads, and the premise of which is really to say that we're kind of at a potential regime change. And that regime change can go, by way of maybe 3 potential paths. And the path that we've, discussed is in, some form of, entrenched inflation, which certainly seems to be building a bit. A path of, let's call it, kind of expanding growth forces or kind of normalized, growth levels. And then, another potential path is, returning to the way things were, the last 10 years post-financial crisis, which is, more or less a kind of secular stagnation where, rates are low, inflation is low, economic growth is fairly muted. And as we look at, these potential paths, we think each of them are associated with a, fairly significant, market repricing. And I think it's hard to predict where will inflation go, where will growth go, where will interest rates go. And I think one of the things that is a takeaway for us as we think about this potential regime shift or kind of the crossroads that we're at is the market adjustment we've seen in the first 6 months. It's fairly rational when you think about the market's trying to figure out where are we going from here. And what we have over the next couple of slides is just some data points that frankly, just confirm that we're in a little bit of a conflicting arena in terms of things that we're seeing in terms of kind of economic data. So a couple of things that we'll talk about here. If we think about the U.S. economy in terms of, the goods economy and the service economy. The service economy is roughly 2/3 of overall GDP, and as you can see, it's fairly positive across the board and consistently positive. One of the data points we've recently had this last quarter is kind of struggles in, let's call it, goods spending, and we've heard terms like a goods recession, or I've heard data points of some retailers offering to pay you to not return items if you're looking to return them, just because inventories are bulging. And I think that's some of the confusing data points that we struggle with, where in some ways, the goods component is still very much feeling the ripple effect of the pandemic in terms of changes in supply chains. And the services component of the economy, which really is what drives long-term U.S. trends, continues to be relatively healthy in the current market environment. And one of the things that we can see with this is when it comes to consumption in terms of kind of retail sales. And the one thing I would highlight is this is a nominal growth number, so this is not real. And so one of the things that this includes is prices are up. So to some degree, this sales growth reflects consumers paying higher prices for things. But I think one of the things that I think we're keenly focused on, market participants, the Fed, and a lot of folks, is to what extent does rising inflation, higher interest rates start to create some sort of demand destruction? And if you think about the price of oil and the price of gas, at which point if oil moves to $200 a barrel, does that start to create some sort of demand destruction in terms of economic activity? We're not seeing that as of yet, but that's definitely something that we're keeping an eye on. And then the other aspect of it, we've got these somewhat conflicting growth data points. And when we think about inflation, wage growth and wage pressures very much remain elevated. There does not seem to be a real significant slowing of wages. And as the Fed increases interest rates and potentially moves away from their hope of, let's call it, a soft landing, you start to run the risk of, we need to raise unemployment in order to reduce inflationary pressures in the market. That's a very difficult political goal to have. That's a very difficult goal to kind of implement. But we could be nearing that if these inflation pressures persist, where unemployment can't sit below 4%. It's got to move, a couple hundred basis points higher at a minimum. And what level of interest rates will be required to cause some of the wage pressure to alleviate? And as a kind of another contrast to that, and when we look at what are we seeing in, let's say, corporate earnings and kind of the economic activity side of things, and again, it's very much a muddied picture. So when we look at overall earnings growth the last 12 months for the S&P 500, it's grown just fine and is fairly healthy earnings growth level. And in some ways, when we look to earnings expectations for the S&P 500 for 2022 and 2023, those index level, high level numbers haven't moved at all from the start of the year, and if anything, are a little bit higher, despite interest rates being higher, inflation bigger concern, all the things that we've mentioned up to this point. But when you dig into some of the data, you can see maybe there is some underlying weakness that actually exists in the corporate earnings profile. And so when you strip out the energy sector, which is clearly benefiting from the higher oil prices and natural gas prices, and you can see that earnings are starting to kind of slow down. Is some of this top line growth or profit margin pressures that are flowing through the earnings side of things, and that will be the big question mark going forward. So if the inflation pressures can continue, or wages continue to rise, eventually that'll start to flow through in terms of profit margins expectations for many corporate entities. But then also, if the Fed raises interest rates significantly, maybe above and beyond what's expected, that starts to reduce overall economic activity. And does that start to raise concerns about top line revenue growth and things along those lines? So these are a lot of the nuanced things that we're really kind of, I think many in the kind of community are struggling with to kind of understand where are we headed over the next 12 to 24 months. And this is really reflected in just kind of how we're trying to kind of logically follow what's the path and what are the potential outcomes that we could see. So in line with this idea of economic crossroads, we're thinking about what are the potential investment regimes that we're seeing, and what do these shifts look like? So just to highlight a couple of these items. So let's say we stay in an outcome where inflation stays high and the Fed lets the economy run hot, or it's a very accommodative policy. Well, it's the type of environment that probably is healthy for liquidity, helpful for nominal growth, and fairly bullish, let's call it, for risk assets, but also kind of starts to build, the potential for asset bubbles in certain areas and pockets of the market. So maybe some of the things that have drawn down more heavily in the first 6 months of the year would benefit from this type of market environment. Or let's say, I think in some ways what maybe the Fed is more keenly aware of and frankly probably pricing into their thoughts is, both the inflation outcome is lower, so inflation comes down to a more normalized level, but also we see a much more tight monetary policy approach from the Fed or central banks. So it's kind of that bottom right quadrant here. So you could say the Fed fights inflation successfully. We've got, a challenge to economic growth, and in some ways, kicks off a recession, which for our vantage point, we never want to, have recessions, but it's healthy for a cycle. It's healthy to essentially reset the system and kind of flush the bad capital out and kind of, regrow, and it's required for a healthy capitalist structure in our minds. And this would represent really just a normal economic cycle. And I think the concern of us and others is we have both a tight policy response from the Fed, but maybe it's not quite enough to keep the inflation outcomes from being high or above average. And this is not necessarily to say inflation stays at 9, but inflation stays at 4 or 5, above average from what the Fed would want as a target. And that starts to, kind of cause a lot of issues in terms of what's our confidence level in central banks to control markets, but also, assets will reprice quite dramatically in the type of market environment. So if we think about interest rates rising to start the year, PE valuations have come down quite a bit. So that type of trend would likely continue. And in some ways, looking to, higher quality, shorter term debt would be an approach for folks to look at should we see that type of market environment. So putting kind of the market backdrop aside, I have a couple thoughts on just how we're thinking about portfolios and how they should be positioned on a go-forward basis. So currently, we're encouraging a underweight risk posture for risk assets, and this really reflects a twofold concern related to the path of earnings, specifically in the U.S. and the globe, and also what is the pathway for inflation dynamics. The market's clearly, in some ways, especially if you look at break-even inflation rates today, pricing in a lower expectation of inflation than they were 3 months ago. But those expectations can quickly move if inflation is truly becoming more entrenched in kind of consumers' minds. The other aspect in terms of positioning that remains kind of top of the list for us in terms of implementation is thinking about value equities, especially in the U.S. So we're encouraging folks to introduce or have value in their U.S. equity complex, and we think very much is a good approach to kind of mitigate some of the macro issues that we face today, for an equity portfolio. And I think thinking about this, all together, I think kind of the one central takeaway to really encourage in this type of market environment is we want to make sure folks have an adequate level of portfolio liquidity. In some cases, this might be a dedicated portion of treasuries, which we do think are very much necessary in this market environment, despite some of the duration price pressures that you're likely to experience with interest rates rising. And also have an assessment of how much liquidity do you need, should you have an extended bear market environment. And it's not to say we want to raise cash to handle 2 years of cash flows, but just be cognizant of if market stress deepens, do you have enough capital at hand to be able to manage capital calls, any sort of outlay in terms of the portfolio might need, and also rebalancing to be able to step back into markets, should there be a further drawdown. And the last piece that I'm going to highlight is, encouraging folks to, build exposure short-term investment grade bonds. It's not the most exciting idea, but I think one thing that we've seen is as yields have increased, frankly, the relative outlook of higher quality bonds relative to risk assets has improved quite a bit. And so, some of the, spaces within that high quality investment grade credit space, especially in the short term side, we're finding attractive. And, building exposure up to that as we speak. So, speaking of which, kind of let's call it the equity versus debt question. One of the things that we've observed when we look at kind of earnings yield or the inverse of the PE multiples is when you compare that to a BBB bond yield, we're seeing that equities or the equity risk premium are certainly less compelling than they've been over the last 10 years. So in some ways, as interest rates normalize and move higher, it really puts pressure under the equity complex in terms of either valuation multiples need to come down, earnings need to be a lot higher, but it certainly gives us pause in terms of thinking about having a more neutral or overweight exposure to equities despite the drawdown that we've seen to start the year. And just as a reference point, I think all of us are keenly aware of this, but just to highlight some of the things that we're seeing and just how dramatic the move we've seen in bond yields. And you can see T-bills have moved quite a bit higher and likely to with the next Fed meeting. And on top of that, when we look at short-term corporate bond yields earning over 4%, and we think that's a nice place to be in a time of potential market stress, and happy to kind of wait out some of the things that we're seeing in the space. That said, one of the areas of the market that we're kind of keenly keeping an eye on is lower quality credit spreads. So high yield, bond spreads. Typically in kind of the NEPC cycle, as credit spreads have widened out, that we've used that as a more dynamic or tactical signal to either step back into credit markets or step back into equity markets. And you can see, there's a cyclical aspect to spreads when they meet market stress. They tend to kind of blow out. I think interesting enough, we've definitely seen some pressures with credit spreads, but considering we're at a 20% drawdown for the S&P 500, spread change is pretty muted. So we'd like to see spreads rise, a bit more before we start thinking about our corporate high yield bonds, an opportunity that we want to pursue. But it's definitely something to encourage folks to kind of keep an eye on. And from a strategic standpoint, earning 9-10% yields and high yield over the next 10 years, it's hard to imagine that's going to be a losing bet, frankly. But we're still waiting currently for spreads to blow out a little bit more before we step in. And just a little bit more on our thesis around kind of U.S. large cap value. I think there's really two things I want to highlight is the concern that we could see quote stickier inflation and higher interest rates. That typically is a headwind for the growth complex or kind of the X value complex. And so we think value is a good place to be within equities to help mitigate some of those pressures. And then on top of that, thinking about should we see inflation normalize long term at a slightly higher rate, that should be better for value exposures as well. And so the large cap value idea within the U.S. is something that very much could be a persistent trend over the next several years for us. The risk, and all things come with risk. The risk is that there's a resurgence of deflationary influences that that really are a headwind for value and benefit the high quality tech names that really ran over the last 10 years. So should we see interest rates fall and inflation fall again, that's definitely going to be a bit of a headwind for value stocks. That said, we've certainly seen some success so far to date in the value complex. You can see the two highlighted the differentiated colors here. Look at the first two quarters of the year. You can see one of the best times to be in value over the last 20 plus years. And I think one thing that keep in mind, if we use early 2000s as a guide, that the potential for outsized relative performance of value versus growth is certainly there, especially if these trends with inflation and interest rates continue. And so just to kind of leave with kind of a higher level thought kind of in regards to kind of a strategic asset allocation outlook. And I think the one thing that is mentioned at the start of the comments is around our economic crossroads is we're really at the precipice of a regime change. It's very hard to predict, and in some ways we need to be we need to be comfortable being uncomfortable. We're likely to be, we could be in a protracted bear market for more months than we anticipate. And we want to be prudent in terms of how we make changes and adjust our portfolios. We just need to be prepared for that a lot of the behavioral biases that we built up over the last 10 years, whether that's in terms of how we view recovery in assets that draw down, or how we view the path of inflation. It's going to be really important for us to be aware of that conditioning that we've experienced over the last 10 years. And the other item I'd highlight is something to maybe just keep in mind, should the path of interest rates continue to rise, as maybe each of you do strategic asset allocation work over the next 12 months, starting to think about, a dedicated allocation to investment grade bonds may start to make sense as interest rates rise. And so thinking about your objectives, your return targets relative to 5-6%, yielding, corporate bond paper starts to make a lot more sense in a strategic context. So with that said, I'm going to turn it over to Josh to walk through some of our thoughts on the private equity complex. And hopefully Josh is off mute and be joining us in a second.
Okay, there we go. Hi, everybody. I'm Josh Beers. Sorry for that. I'm Josh Beers. I'm going to walk you through the private equity markets here. What I'm going to ask from you all in the beginning is re-gear a little bit and view this through a very different lens from what you just viewed through when you were listening to both Phil and Jen talk. Private markets commitments by nature are strategic, okay? It's really hard to time these markets. And so I need you to get in that mindset. So with that, one of the things that we are starting to get a lot of questions around is the denominator effect. And what is the denominator effect? Well, that's when you see a material sell-off like we have seen in the public markets, and that valuation reset not make it to your private equity portfolios. That typically takes somewhere around a quarter or two. What this results in is what would appear to be a high exposure in your private equity markets relative to your public equity exposures, okay? We do think over time, as managers start to mark to market, you will start to see those exposures creep down and come in more in line with your policies, okay? So with that in mind, a couple things I want to touch on here. Vintage year diversification is key, okay? The real reason for that is if you historically look back, vintage years during recessions tend to be your outperforming years. And so you want to make sure that you're capturing that within your pacing, okay? The other thing is you want to maintain new commitments to, or maintain capacity for new commitments to managers. This is a really great opportunity potentially to upgrade your list of managers. There will be LPs that are distressed, that are unable to make commitments to the space. That's going to leave the door wide open for you to come in and be able to access managers that have typically been really difficult to access. And then lastly, if your business model requires you to think about your illiquidity and how that will affect your business, then what we suggest is scaling down your commitment sizes, not exiting your commitment sizes, okay? So if you have to, in extreme cases, like cut your commitments in half, what this is gonna do is you've worked really hard to get access to some of these managers, and you don't wanna give up that seat at the table. So you wanna make sure that you're committing to the very best and maintaining those portfolio exposures. Okay, with that, why don't we get into what we're seeing in the market? So what you're going to see here on the left-hand side is U.S. private equity, your buyout strategies. On the right-hand side is your venture strategies. First thing that jumps off the page here is that fundraising's way down. Okay, it's coming off a historic high from 2021, and the first half of the year was extremely robust. The other thing that I want to bring to your attention on this slide is that timelines are starting to get extended out. So for the first half of the year, from close to finish, most managers were raising capital somewhere between the 3 and 6 month period time frame. Today, what we're hearing and what we're seeing is somewhere closer to that 8 to 10 month time frame. Most managers today that are currently in market are likely holding either a rolling close into 2023 and or some sort of final close into 2023. So the question is, why is this happening? So if we go to the next slide, deal activity is way down, okay? So both in the buyout and venture space. Why is that? Well, managers in general are being very thoughtful with the most recent sell-off in the market of where they're deploying their capital. The other reason is that if you can see from this chart, over the last 18 months, a lot of companies have raised a lot of capital at monster valuations, putting a lot of cash onto their balance sheets. Most companies, if they don't have to, won't go out and raise a down round. And so what they're doing is they're trimming their income statements, they're trimming their expenses, and looking to slow their cash burn. They're going to do that for some time. I suspect that most companies are going to have to raise capital somewhere in Q3, Q4 timeframe. Okay, so if we go to the next slide, we'll talk about just valuations in general. I want to bring your eyes over to the right. That's your venture landscape, okay? So the first thing is that top line, that yellowish line, if you will. That's your late stage venture. What you're seeing there over the last couple of years, valuations at that end of the market have been on an absolute tear. We're starting to see that subside quite a bit. What we're hearing from managers right now, a flat round is your new up round. And so we're seeing more flatter rounds. I do suspect that around that 105 is going to come down as we head into Q3 and Q4. Your dark green lines, now we're going to get into much earlier stages where it is up 45 going to 60. I do suspect that is a matter of not many companies right now are in the market raising those rounds, so they can't value those companies yet. So that's one thing. And two, I do suspect somewhere in that Q3, Q4 timeframe, just given cash burn with a lot of these companies, we're going to start to see some down rounds creep in there. So that 60 is likely to come down towards the end of the year. Where we are seeing some of those valuation resets, and it makes a lot of sense, and that's why I think in the little later stages here, we're going to start to see that, is in the much earlier stages. So think of the seed angel rounds. These are where companies have raised a couple million. They come back to market often, they're burning cash, and so they have to come back to market. What we're seeing there is those are your two blue lines, more flatter rounds being done there, and in the case of the angel, that median coming down off of 2021. On the left-hand side is your buyout space. One of the things that we're paying really close attention to is how much leverage is being used. And so we're being mindful of that. We'll get into a little bit more about that on the next slide. But the last thing I just want to leave you with, that 2022 number there is likely to come way down. I suspect that that has companies that had struck deals in 2021 and closed in 2022. So that valuation would be a little bit misleading, and we do expect that to come down heading into the end of the year. So we go to the next slide. I wanted to leave you with best practices here to sum up the private equity market. Many of you have seen this slide before, and so I apologize, but I think it's really important that you keep this in mind as you think about your private equity portfolio. We want you to be consistent, okay? Use your pacing plans. It's really important that you get exposure to vintage years. Quality does matter, okay? Back your very best managers, continue to back them, look for opportunity to upgrade your portfolio. Couple areas that we're paying really close attention to as we think about our underwritings here at NAPC. You saw some valuation reset at the later stages. That's a place that we've been pretty bearish over for the last couple of years. And it's got a long ways to go, but we're paying close attention to those valuations. If those start to continue to show more reset there, that could be a good opportunity. US secondary co-investment opportunities could be a really great place to be deploying capital as well. not only are you going to pick up the discount that you typically pick up from a secondary, but you may be doing that coming off some historic high valuation. So you're also picking up a valuation reset, if you will. On the buyout side, you want to look for managers that are being prudent with leverage, right? We're heading into a market which we suspect will be higher interest rates. So you want to be mindful of how much leverage is being used at these companies to make sure that their operations can facilitate that leverage. The other place of opportunity is those managers that could be opportunistic and protect their downside, really looking for those value plays. And then lastly, what I want to leave you with is just be really mindful of your sector allocations, okay? Not in the context of your private equity portfolio. You need to view this in the context of your overall portfolio. Just to give you an example, if you're putting a lot of capital to work in the venture space, you're picking up a lot of tech exposure. You need to view that in the context of how much tech exposure you have in the public equity space. And then also from a geographic standpoint, be mindful of being diversified there too. So really think of kind of the US, Europe, and Asia, how that plays in your portfolio. Okay, looking forward to your questions. With that, I'm gonna kick it back to Phil.
Great, thank you, Josh. And maybe just as a really quick item before we get to questions, wanted to highlight kind of a really important initiative that we're excited about at NEPC, and that's the upcoming National Summit on DEI hosted by IDAC. And IDAC, or the Investment Diversity Advisory Council, was launched by NEPC and 10 other asset allocators in 2022. And it's an independent entity that's really designed to share best practices on diversity, equity, and inclusion in the asset management industry. And as kind of the work is evolving on this, there's really three main points of interest that I want to mention that this group is working on. First is kind of what's the vision for IDAC, and it's really to encourage a broader, deeper kind of pool of talent and workforce that can frankly lead to better investment outcomes for stakeholders over time, we believe. And then also, from a mission standpoint, the goal is to transform really the financial industry's willingness and also kind of open access for talent from underrepresented groups. And as we think about kind of objectives, it's really important in our minds, and kind of the IDAC group as well, in terms of kind of goals they're setting, is thinking about potential goals and targets. And some of that is looking to double the AUM participation of diverse owned and women owned managers to 3% by 2025. So these are some of the things that this group's going to be talking about and sharing and debating in some cases. And so we're really excited about this important initiative. And if you do want more information, please contact diverse managers at NEPC. And obviously you can see on the slide here. And again, this will be this deck will be shared with everyone that's dialed in, and also be available on our website for folks that need this reference point. So with that, we're gonna get into questions. Maybe the first question for Jen is thinking about kind of market expectations for inflation break-even rates. They're much lower. How does this reconcile with your comments on inflation, and any thoughts on why they've moved so much lower in the last month or so?
Yeah, thanks for the question. I'd say first and foremost, just from a context standpoint, we've been working with an inverted break-even inflation curve for quite some time, meaning that near-term inflation expectations are above longer-term expectations, which have been more anchored to that more subdued inflation environment. And so what we've seen over the last few weeks is, in part, I would say, because of the updated CPI print, and the market is now pricing in expectations for at least a 75 basis point hike. So inflation break-evens have fallen quite a bit, which suggests that the market's buying into the fact that the Fed may successfully kind of fight inflation and maneuver a soft landing with restoring price stability on one end without completely destroying the economy. The other thing that is probably having a smaller role, I have to acknowledge that commodity prices have come down quite a bit. So that's one thing that could be creeping in there too. But just to bring it back to Phil, what you mentioned earlier on, that these expectations can change. So we've seen them bouncing around quite a bit over the last year. And I think if we start to see some of those things I identified that craft more of an upside case for inflation, then we will see these move. But this is a really key metric that we pay attention to.
Great, thank you. Thank you, Jen. Next question, I'm going to throw over to Josh. And as we think about kind of the market dynamics we've seen in public markets so far this year, any expectations or any thoughts around potential markdowns we're likely to see in private portfolios soon?
Yeah, it's a really great question, and one that we're getting a lot from our clients. So I suspect that Q2, as those valuations start to come through, you're likely to see flat performance there, maybe slightly down, is what we're getting from our GPs. Where you're likely to start to see write-downs, if we continue to have this volatility in the market heading into Q3 and Q4, as I mentioned, that's when companies are going to have to go out and likely raise capital, and that's when they're going to strike a valuation. And so we were expecting that to flow through. And on the buyout side, they're going to start really marking that stuff to market. So again, likely Q3, Q4 is when we'll start to see material valuation resets if we continue in this environment.
Great, thanks. And then maybe a quick question that I'll throw my way, I guess. Came in and kind of thoughts around kind of long-term equity valuations in terms of whether it's the CAPE, or which is a cyclically adjusted PE multiple, or with the price declines, what's our thoughts on fair value for let's call it the U.S. equity complex. And I think one of the things that we've seen is despite equity prices coming down 20-ish% for the U.S., we're still seeing somewhat elevated PE multiples relative to history. And when I say relative to history, it's thinking about what's the market regime or the last 40 years. Now, if we think of a market regime where interest rates are very low, we think PE multiples should be higher. So as interest rates rise, we are anticipating PE multiples to come down in terms of how we set some of our long-term capital market assumptions. There also is a variable component of rising long-term interest rates are going to start bringing down PE multiple targets as well. So, I mean, a short answer to say is we're not necessarily seeing that the overall equity complex is looking particularly cheap or undervalued, but it's moving more towards fair value, obviously, as prices decline. And then maybe last question, and just a quick one for you, Josh, is if we see kind of a continuation of market conditions, how do you see kind of changes maybe occurring in terms of private market capital calls and portfolio distributions?
Yeah, really fair question. So over the last couple of years, a lot of portfolios have benefited from high distributions paying for capital calls. I suspect as we head into Q3, Q4, into next year now, if markets are consistent from what we're seeing today, more or less that IPO window is closed. There's not, as you saw from deal activity, there's not a whole lot of activity that's occurring. So not a lot of activity on the M&A front. What that means is you should expect distributions to slow. And then on a contribution side, you should expect those contributions start to either remain pretty consistent and or start to tick up a little bit as they start to support, as they, being the manager, start to support their portfolio companies and their winners into this environment.
Great, thanks. And one more question that came in that I think is important. I want to make sure I want to hit on in regards to our kind of value theme. What are some of the sectors that ideally we'd like to pursue, or industries that we think are attractive in these types of market conditions? And I think probably the two or three that come to mind the most are you know, as interest rates rise, and let's say there's more macro variability, you know, the financials complex, you know, some of the industrial complex, more of the consumer staples as well, you know, start to become a more attractive option, especially in the value context. And then, you know, frankly, as the inflation levels rise and kind of, you know, continue to stay elevated, you know, energy stocks obviously are going to benefit from that, and you know, those are more heavily represented in the value index. And I think as we think about, you know, from folks as they think about, you know, their investments in regards to energy and, you know, various kind of SRI, you know, focuses or objectives, I think that's going to be for each investor to assess, you know, does a portfolio make sense that does include energy, or are there other ways to structure a value theme? And we think there are at times, to be able to, you know, access kind of the value factor, if you will, without maybe having to over anchor to energy stocks, or, you know, stocks maybe screen poorly depending on folks' views on SRI objectives. So that is the last of the questions. We went a little long today, and you know, appreciate everyone taking the time to listen. And as I said before, this will be available on our website, and both recording and the slides. And looking forward to everyone joining us next quarter for our next Outlook webinar. Thank you, everybody.